You've probably seen it, right? The image of a Wall Street hotshot surrounded by five glowing monitors screaming into a phone, making some billion-dollar bet on a company you've never even heard of. It's the classic picture of high finance, and it makes building a massive portfolio feel impossibly complex, like a secret club you're not invited to. And honestly, that's exactly what the financial industry wants you to think. They profit from complexity. They make a killing when you feel overwhelmed, when you feel like you have to pay them for their expert advice just to have a shot. But the truth is, the proven strategy to build a seven-figure nest egg is shockingly simple. It doesn't require risky stock picking, day trading, or some secret algorithm. All it takes are three specific types of ETFs, a little discipline, and the patience to let the most powerful force in the universe, compound interest, do the heavy lifting for you. In this video, I'm going to give you the exact blueprint. We'll break down each fund, the specific job it does, and show you the math on how this simple strategy can systematically build a million-dollar fortune for pretty much anyone. First things first, let's tear down the biggest lie in modern finance, that investing has to be complicated. Turn on any financial news channel and you're hit with a tidal wave of jargon. Alpha, beta, inverted yield curves. It's a language designed to confuse. You're faced with a wall of thousands of stocks and well over 4,500 exchange-traded funds, ETFs, in the US alone. This isn't to help you, it's to intimidate you. It creates a sense of paralysis, that fear that if you don't understand every single moving part, you're going to lose all your money. So what do most people do? They freeze, they do nothing. They leave their hard-earned money in a savings account where inflation eats it for lunch, losing value every single day. Or they swing for the fences. They hear a wild story about a friend of a friend who got rich on a meme stock, and they throw their money at a single speculative bet, praying to hit the lottery. More often than not, they get burned. This is the system working exactly as designed. The industry wants you to think you only have two choices: be a stock-picking genius or be a helpless bystander. But there's a third way. The way that built the fortunes of countless regular people who understood one simple secret: you don't have to beat the market, you just have to own the market. You don't need to find the one winning needle in the haystack, you just buy the whole haystack. The beauty of this approach is that it defeats the two biggest enemies of every investor: high fees and runaway emotions. By choosing broad, diversified, low-cost funds, you sidestep the crazy fees that active managers charge to, more often than not, underperform the market anyway. And by setting up an automated investment plan with just a few funds, you remove the temptation to panic sell in a downturn or get greedy at the top of a bubble. You put your wealth building on autopilot. This isn't just a strategy, it's a philosophy, and it's the foundation for our three-fund millionaire portfolio. Before we build the new portfolio, we have to talk about why the old rulebook isn't cutting it anymore. For decades, the gold standard of safe investing was the 60-40 portfolio. 60% of your money in stocks for growth and 40% in bonds for safety. The idea was simple. When stocks went up, you did great. When stocks went down, your bonds were supposed to be the shock absorber, holding their value or even rising to cushion the blow. And for a long time, it worked like a charm. But the world has changed. We've just lived through a bizarre period of historically low and then rapidly rising interest rates. That has completely flipped the script for bonds. See, when interest rates go up, the price of existing bonds with lower payouts goes down. So many investors who thought they were safe actually saw huge losses in their safe money. For instance, an ETF that tracks long-term treasury bonds like TLT saw a painful 5-year performance of roughly minus 35%. On top of that, with inflation being a factor, the yields on these bonds often struggle to give you a real return after you account for the rising cost of living. While bonds are expected to play a more helpful role in portfolios in 2026 as things calm down, the reliable diversification they once offered has been seriously tested. Relying on them for 40% of your portfolio, especially when you're young, can be a major drag on the growth you need. The safety part of the portfolio suddenly became a source of risk. This doesn't mean bonds are useless, but the idea of a rigid 40% allocation for everyone is just an outdated concept. A modern portfolio needs to be more dynamic. It has to find stability and diversification in smarter ways without giving up the growth that's essential to hitting that seven-figure goal. Our three-fund philosophy is built for this new world. The secret to simplifying all of this is to stop thinking about owning hundreds of different things and instead think about assigning just three essential jobs. Every successful long-term portfolio needs to do these three things. 1. A solid foundation. You need a core holding that's incredibly broad and stable. Its only job is to capture the growth of the entire economy reliably and consistently. This is your bedrock. It's not flashy, but it is unshakable. 2. A growth engine. You need a part of your portfolio dedicated to supercharging your returns. Its job is to give you concentrated exposure to the most innovative, fastest-growing companies on the planet. This is what can dramatically shorten your timeline to $1 million. 3. A diversifier and stabilizer. And finally, you need something that zigs when the others zag. Its job is to provide stability and reduce risk by giving you exposure to assets that don't move in lockstep with your main U.S. holdings. Think of it as your portfolio's insurance policy. That's it: foundation, growth, and stability. Every dollar you invest gets one of those three jobs. This framework is inspired by the legendary founder of Vanguard, Jack Bogle. He revolutionized investing with a simple idea: stop trying to beat the market and just own it with low-cost index funds. He called the constant hunt for the next hot stock a loser's game. The winner's game, he said, was to buy a slice of the entire market and just hold on. Our 3 ETF strategy is a modern spin on Bogle's philosophy. We're using 3 funds to strategically balance these jobs, giving us that steady foundation he loved, but adding a targeted growth element and a modern stabilizer to really optimize the path to wealth today. Alright, let's get to the good stuff. We're going to assign one powerful, low-cost ETF to each of the 3 jobs. Now remember, the tickers I'm using are just great examples. The specific fund isn't as important as understanding the role each one plays in your portfolio. The first and biggest part of your portfolio is the foundation. Its job is to give you steady, reliable growth by owning a piece of the entire U.S. economy. There's no better, more proven way to do this than by owning the S&P 500. Our choice for this job is the Vanguard S&P 500 ETF, ticker symbol VOO. VOO's job is dead simple. It tracks the performance of the 500 largest, most profitable public companies in America. When you buy one share of VOO, you instantly own a tiny piece of Apple, Microsoft, NVIDIA, Amazon, and hundreds of other companies that drive the global economy. You're not betting on one company to win, you're betting on the long-term success of American business itself. And history has shown that's one of the safest and most profitable bets you can make. One of VOO's best features is its ridiculously low cost. Its expense ratio is just 0.03%. That means for every $10,000 you invest, you're paying just $3 a year. Compare that to some actively managed funds that can charge 1% or more, costing you hundreds of thousands of dollars over your lifetime. VOO is your long-haul trucker. It will have its ups and downs, but over the long run, the S&P 500 has historically delivered average annual returns of around 10%. The 10-year total return for VOO as of early 2026 is an incredible 290% or so. This is your core. It should make up the biggest slice of your portfolio, around 50% to 60%. It's boring in the best way possible, it just works. If VOO is your steady foundation, this second ETF is your growth engine. Its job is to provide supercharged returns by focusing on the most innovative and fastest-growing companies out there. For this role, our pick is the Invesco NASDAQ 100 ETF, ticker symbol QQQM. QQQM tracks the NASDAQ 100 index, which is home to the 100 largest non-financial companies on the NASDAQ exchange. This basically means you're owning the titans of technology. Companies like NVIDIA, Apple, and Microsoft make up a huge chunk of this fund, giving you a heavy dose of things like artificial intelligence, cloud computing, and semiconductors. While VOO owns these companies too, QQQM gives you a much bigger, more concentrated bet on them. And that concentration is the whole point. The goal here isn't broad diversification, it's targeted growth from the cutting edge of the economy. This is the part of your portfolio designed to crush the broader market during good times, and historically it has. Over the last decade, its parent fund QQQ delivered a total return of nearly 500%. But this is a big but this higher growth potential comes with higher volatility. When the tech sector stumbles, QQQM will fall harder and faster than VOO. That's the trade-off. This is why it's not our entire portfolio, but a strategic allocation of around 20% to 30%. It adds a powerful growth lever that can seriously shorten your path to $1 million without risking your entire nest egg. And with a low expense ratio of 0.15%, it's a cheap way to add that horsepower. The final job is the diversifier and stabilizer. This fund's purpose is to add a layer of defense and to own things that perform differently than your U.S. growth funds. This helps smooth out the ride. Here, you get a choice based on what you value more. Option A for income and quality, Schwab U.S. Dividend Equity ETF SCHD. If your goal is to add stability and a growing stream of passive income, SCHD is a fantastic choice. This ETF doesn't just chase stocks with high dividend yields. It has a strict set of rules to find about 100 high-quality, financially sound blue-chip companies that have a long history of not just paying, but growing their dividends. Think companies like Coca-Cola, Verizon, and Home Depot. These businesses are usually less volatile than the tech stocks in QQQM. During market downturns, they tend to hold up better and they keep paying you cash that you can reinvest to buy more shares while they're cheap. Holding 10% to 20% in SCHD adds a defensive, value-focused balance to your growth-heavy portfolio. Option B, for global diversification, Vanguard Total International Stock ETF VXUS. If your main goal is to make sure you're not putting all your eggs in the American basket, then VXUS is the perfect choice. This one fund gives you ownership in thousands of stocks from all over the world, from Europe and Japan to emerging markets like Brazil and India. Why does this matter? While the US market has been on a tear for the last decade, history shows that US and international markets often take turns in the lead. For example, in 2025, international stocks, as a group, actually beat US stocks, with VXUS returning over 30%. Owning VXUS ensures that no matter which region of the world is doing well, you have a piece of the action. Allocating 10% to 20% here is the ultimate diversification against the risk of a single country's economy hitting a rough patch. Whether you choose SCHD for its quality and income or VXUS for its global reach, the job is the same: to make your portfolio more resilient. This all sounds good, but what does it actually look like to get there? This is where the magic really happens. The journey to $1 million isn't about one brilliant move, it's about small, consistent actions repeated over time. Let's run some numbers. We'll assume a blended annual return of 10%, which is in line with the S&P 500's long-term historical average. And a quick heads up, these are simplified examples to show the power of the concept. Real-world returns will vary, and things like taxes can affect your final number. Scenario 1, the determined saver. Let's say you start with nothing and invest $500 per month. It might not feel like you're moving mountains, but just watch. After 10 years, your portfolio would be worth about $102,000. B, after 20 years, it would balloon to over $378,000. C, and after 28 years, you'd cross the $1 million mark. You'd become a millionaire by consistently putting aside about $16 a day. Scenario 2, the ambitious investor. Now, what if you can find a way to invest $1,000 per month? After 10 years, you'd have over $204,000. B, after 20 years, your portfolio would be worth a massive $757,000. C, and you'd hit your $1 million goal in just over 22 years. By doubling your monthly investment, you cut 6 whole years off your journey. This is compound interest in action. Every dollar you invest becomes a tiny worker earning more money for you. Those earnings then become new workers, and the whole thing snowballs, starting slow and then accelerating like crazy. This is why the most important factor isn't how much you start with, but that you start and that you keep going. So you have the 3 funds. How do you actually do this? The goal is to get it all running on autopilot so you can get on with your life. It's just 3 steps. 1. Setting your allocation by age. Your ideal mix will change a bit depending on your age. The more time you have, the more aggressive you can be. For the young investor, 20s and 30s, you've got decades to grow, so you can lean into that growth engine. A great starting mix would be A, 50% VOO Foundation. B, 30% QQQM Growth Engine. C, 20% VXUS or SCHD Diversifier. For the mid-career investor, 40s and 50s, you're still growing, but you might want to start protecting what you've built. A more balanced mix could be A, 60% VOO Foundation. B, 20% QQQM Growth Engine. C, 20% SCHD or VXUS Diversifier. Here, we're just bulking up that stable foundation a little bit. To automate everything. This is the absolute key to making it work. Set up automatic transfers from your bank to your brokerage account for every payday. Don't wait to see what's left over, pay yourself first. This is called dollar cost averaging. By investing a fixed amount on a regular schedule, you naturally buy more shares when prices are low and fewer when they're high. It takes all the emotion and guesswork out of the equation. 3. Annual rebalancing. About once a year, take a peek at your portfolio. Because your funds will grow at different rates, your percentages will drift. Maybe after a huge year for tech, your QQQM holding grew from 30% to 35% of your portfolio. Rebalancing is just selling a little bit of the winner, QQQM, and using that cash to buy more of the others to get back to your 50-30-20 target. It's a disciplined way to force yourself to sell high and buy low. It's a simple risk management trick that keeps your portfolio on track. So there you have it, the simple, proven, 3-fund blueprint for $1 million portfolio. You don't need to be a Wall Street wizard, you don't need to get lucky, you just need a plan. A foundation like VOO to own the US economy. A growth engine like QQQM to supercharge your returns. And a diversifier like SCHD for stability or VXUS for global reach. That's it. Building wealth isn't a game of complexity, it's a game of discipline. It's about picking a simple, effective strategy and having the patience to stick with it. The market will go up and the market will go down, but the long-term trend of human innovation and economic growth is always up. By owning a piece of it, you're making sure your wealth grows right along with it. If this video helped clear things up for you and gave you a real plan, do me a favor and hit that like button and subscribe. My whole goal here is to give you the simple, no-fluff strategies you need to build real wealth. Drop a comment below and let me know which fund you'd pick for that third stabilizer slot, SCHD or VXUS. Thanks for watching and let's get started on that journey.